Okay, welcome everyone. We'll start our fifth lesson, which will be our last lesson on financial management, and we're supposed to cover under this lesson our last learning outcome, understand performance measurement system. So we'll go through today performance measurement system. So before starting our lesson, just a bit recap what we learned up to now. So we learning outcome one, where we discuss about external environment, we discuss about resource-based view, we discuss core competencies, value chain, learning outcome two, where we discuss about financial theories, we discuss about balance scorecard, we discuss about capitalized pricing model, and under learning outcome three, we learn about organization cultures, beliefs, values, we discuss about the stakeholder analysis, different models. So under the learning outcome 4, we discuss about cultures and different cultures, different values. We discuss about chain management, what is meant by chain management. So all this we discussed during our last lesson, learning outcome 4, where we discuss about culture. So what we know about culture? Anything we know about culture? Hello.
Yes, Anand. Can you give me a minute?
So we looking now. We'll go through. We discuss about culture in creating a strategy. We discuss about analyze the role of chain management, and we discuss about the role and effect of the culture on the chain. So during our previous lessons, we cover about all these things. Anybody any question? Feel free, drop me email. So today lesson. Okay, so we discuss about during our previous lesson, so we'll go through now. Investment appraisal. Today lesson will be focused on the investment appraisal techniques, where we'll discuss about payback period, discounted payback, accounting rate of return, net present value, internal rate of return, risk appraisal, project risk. So all this will be focused today lesson. We'll discuss about different sources of finance, how we can borrow the money from different sources of the finance. This is quite, it's crucial to be look around, and quite, because when we borrow the money, actually you're putting yourself risk. We need to be look around ourselves, what are the best option, is it short term, long term, and medium term, so which we'll all go through, and different ratio analysis which we'll go through today as well. So please, if you have any question, just ask me, so I'll go through with you. Okay, yes, anybody any question?
I think we can start.
Okay, so we'll start now. So we doing our last lesson, so everyone will start. So what do you know about investment appraisal? Anybody any thought about investment appraisal?
When we are kind of calculating the risks and the rewards involved in our investments, so that is called appraisal. And investment appraisal means like appraising our investment.
Brilliant. So investment appraisal is like checking the performance, the money we'll invest, the pound we'll invest, the whatever currency will the money will invest. So what we'll get out of it. If we are getting out of the money, and what will be the real value of the money in future? Because the pound we have today, the currency we have today is more value the money we'll get after 1 year. If we'll say £100 we have today, £100 we'll get after 1 year. So the £100 today is more value than the £100 we'll get in future. So because with the passage of time, the value of the money is dropped, it depreciates. So that's why we need to look around. Okay, what about the performance system? What is meant by?
Performance systems.
Yes.
No, I haven't got any idea specifically about.
Performance system mean how we measure the performance of organization. So how we can set a system to measure the performance in a organization. So which is investment appraisal is a one system to check the performance of the money we'll invest, what we'll get out of it. Ratio analysis is a second, really we need to look around, and third, when we borrow the money we need to look around, what are the best sources of finance. So we need to set the system on what basis we decide which one is the best. We can look around when we're looking the performance, we're looking the risk, we're looking the reward, and we're looking the time as well, how long will it take, because time itself is cost. So we're looking the opportunity cost to measure the performance as well. So these all our discussion will be focused. So we'll start. Investment appraisal is a business concept which consists of expected future incomes to be derived from the investment with the expenditures of incurring the investment. So it's all about the money we'll invest, the money we will get. So we need to look around, what will be the real value. In non-profit making organization where investment is not made on the objective of earning a return. So still we need to look around how many customers we are serving, how much we are saving. All this we can use as an investment appraisal. So concept may not always be directly applicable. In such organization, investment appraisal technique may be used. Compare alternative proposal in order to provide the best value for money. So value for money, how we serve our customer, our client. If we are non-profit organization, how well we reach more customer, how well we'll serve more customer, how we'll provide the value added product or the services in our organization. So all we can look around under investment appraisal system as well. So appraisal is used to look at the potential capital investment by a firm, measure its potential value to the firm, and there is a more than one method of investment appraisal. So there are the number of investment appraisal. So method. So investment appraisal method today we'll discuss about payback period, discounted payback, net present value, IRR, which we call internal rate of return, sensitivity analysis, break even, ARR. So we'll go through few methods, and other, please, I'll upload some theory behind, so please go through as well. When you write your assignment, you can pick, one or two, not more than 3 methods really, where you can compare and contrast. So which we'll go through. Okay, time value of money. Anybody heard about or you learned before time value of money? What is time value of money?
The same.
So time value of money.
Okay, so the same concept of investing £1 in today, what it has some kind of value in the future.
Okay, well done. So money is depreciate its value. So we need to discount. So normally we use formula 1 divided by 1 plus R. R is mean the discount factor. So we'll depreciate 1 divided by 1 plus R. We saying 10% we are going to depreciate value of the money in a year's time. So 10% we can write 0.1 here.
Yep.
So if we'll divide 1 divided by 1.1, so what answers we'll get? You want to try?
Yes.
So 1 divided by 1 plus
1 by 1.1 is 0.909.
So after 1 year, we'll get the value £1.909. So if whatever answers come, you divide on again 1.1. So year 2 will get around
0.826, sorry.
0.826. So that's the second year discount factor. So then divide again 1.1. So third year will 0.751 or 75 something, yes.
Yep.
And then, so in this way, you will see there after 1 year, it will be £1 value 909. After 2 years, it will be 82 pence around, yes, 83 pence. And after 3 years, it will be around 75 pence. So the 10% is dropped. So this way we can calculate our discount factor. Normally discount factor is a table we can use, we can find within a books with normally given. I'll upload, the copy of the discount factor table, so you can use discount factor table. You can look around how much percent. So discount factor, how we'll decide discount factor? So there on the number, we use the concept cost of capital. If you borrow the money from someone, how much cost you? What is the inflation rate first? So inflation, first suppose we have a 3%. If you borrow money from the bank will charge you maybe 7% interest on it. Yes. So that makes around 10% is cost of capital. So what is cost you if you borrow the capital from others? So we are saying, okay, we'll see on 10%. So it's costing me 10%. I don't want to earn 10%. I want to be earn more than 10%. So if I'm earning 10%, doesn't mean I'm on break even. So if I'm earning more than, so I need to be look around the real value of money. So first method today we are using is called payback period. What is meant by payback?
And the period in which we kind of receive the return, or the kind of a loan when we pay it back.
Yeah. So payback period, like, so let's assume you're doing this course and you're investing money. So that investing money, how long will takes you to recover your investment? So if we are investing, we'll go through examples in next slide. So if we are investing £10,000, if we are getting £5,000 each year back, so it means it takes 2 years to cover our £10,000 back. So if you're investing on education, maybe it takes 2 years, 3 years, 5 years. What you will get, the job, and you will recover the money you will invest. So that's your initial investment, but it's not mean after the payback and you recover your initial investment, you not get any reward, because the knowledge is forever. It's not mean you recover the money in terms of the job you're getting and you're recovering what you invested on your education or development, but its benefit is stay forever. So normally the payback period, we just using how much we invest, how much we are getting back, and how long taking us to get back, which we'll go through next slide. So payback period is quite simple method, easy to use. Is assist with the cash flow. Here we looking always cash flow. How much money coming in, how much money going out. Affect with the fast technology. If we are investing in Apple technology company, we really want quick return, because technology can be quickly obsolete. So any project have a less payback period, less time will takes to cover the initial investments, which is better than any other project will take. So if we are investing in oil companies, normally is a long term. It takes a while, to recover the money which you invest, but maybe return on your investment forever, because oil will carry on coming out, we'll carry on selling, we carry on getting benefit out of it. Payback period is easy to understand, easy, which is quite good in effective tech when the technology is changed. But what are the disadvantages? It's not looking, it's ignore the flow of the cash over the lifetime of the project. We're just looking what we invest, what will cover, and how long will it take. Is ignore the total profitability of the project. Is only concerned what you invest, what you get back. Only we're looking in terms of the time. We are comparing with options. So that's we'll go through, and that's one example. That's one other example. So we'll go through this example here. So we are investing £3,100 in business, in project. So that £3,100, year zero mean is a current year, the year which we are investing the money. And you can make third column is called cumulative. Cumulative mean total. So if you're investing 31 is going out of the business. After 1 year, you're getting £1,000 back, which we call inflow. Inflow mean the money in. Outflow mean the money out of the business. Cash flows is mean both inflows and outflows. So here the money we are getting £1,000 back. You invested 3,100. So if you're getting £1,000 back, so how much is outstanding to recover still? So that is 2,100. The next year you're getting 2,900 pound back. So is left 1,200 pound. The year 3 you're getting 800 pound back. Yes, and was left. So we have an outstanding end of 3 years is 400 pound. But if you look in after 3 years, we sure this project will take 3 years and some months, because in the year 4 we are getting 500. We required to meet our initial investment 400, but we are getting 100 pound more than the money required to cover the initial investment. So what you do, outstanding amount, which is 400, yes, end of 3 years, and the 4th year how much you are getting, which is mean in the following year your inflow, which is 500, and times by 12. So this project will take us 3 years and 10 months to recover the amount of 3,100 pounds. To cover the amount, whatever we invested, 3,100 will take us 3 years and 10 months. Is it okay? So that's the concept. We can use it. That's the concept, really we need to learn. And same we can use other methods as well. We'll see, and next we'll learn. So that's all about the payback. So maybe if other project we are comparing with other option, maybe other option is 2 years will take us to cover the 3,100 pound. So according to the payback period, we'll prefer the project those will be takes less time, and we invest and what we'll recover the money. So if the Apple is taking us 2 years and the British Petroleum or Shell will taking us 4 years, so we'll prefer to be 2 years instead of 4 years. Maybe because of the opportunity cost involved. If you get the earlier money, you have a less risk if you get the late money. So that's what really we need to go through. Any question?
I think we're good.
Okay, so next we're looking now, discounted techniques are used in the calculating the net present value of the series of cash flows. So discounted cash flows. This measures the change in the shareholder wealth now as a result of accepting a project. So NPV, net present value of the cash flows less the present value of the outflow. So we're looking the present value. If you're saying, if you borrow or lend money to someone 100 pounds and someone say, oh, I'll pay you 100 pound back after 3 years. Actually, you getting your 100 pound back. Actually, you're not getting your 100 pound back. That 100 pound won't be 100 pound value. So that 100 pound maybe you getting in real world, you getting maybe 88, 85 pound back, because 3 years is a long time. In 3 years is the money. So that's why even it's morally is good to be lend money, but in the real world, as the value of the money wise, we are dropping money. Yes. Maybe other we can argue that's a religious or the perspective. That's absolutely fine. But in a corporate world, we looking the money you have today is better than the money you will get in future. So all this will be based on which we'll go through few examples. So NPV, always remember when NPV is a positive, we accept the project. When NPV, net present value, when is a negative, we reject the project, which I'll give you example in next slide. So what are the advantages, disadvantages? This method is quite good, is maximize the shareholder value. Consider the time value of money and use all the cash flows. We do not by in the payback period, what you invest, you recover, that's fine, stop. You don't need to make a really calculation afterwards. But in the NPV, we can carry on getting and carry on calculating our benefit. Some benefit for suppose can be forever. So one difficulty is this problem or disadvantages we can. If I'll say time value of money, how well we can explain what is meant by value of money. Value of money is not always the certain thing. There are number of forces involved that can be influence the value of money. We depreciate maybe on 5%, 10%, looking this and that, but actually think about in terms of foreign currency, in terms of other currency, in terms of economy. So there are a number of factors. We calculate the cost of capital. Cost of capital is carry on chaining. I'm saying I'll depreciate on 10%, maybe others say I will discount on 15% in other countries. So that is quite complex concept as well, which is quite difficult to explain sometimes. So that's why this method is not useful in those cases compared to the payback period. So we are going through now NPV and we'll see here. So let's, we are investing this time £20,000 in a business. Year zero is the investment. And at year zero mean the current year £1 is £1. The £1 value is £1. So 20,000 times 1 is give us 20,000 as a present value. Is a negative sign because the money we have invested. So we are depreciating by 10% using the 10% discount factor, like we quoted earlier, formula 1 divided by 1 plus R. So we are using this formula. So 5,000 you getting back after 1 year. Actually, the £5,000 we are getting back, that 5,000 is not actually 5,000. In real value, that 5,000 will be 10% depreciate, mean you are getting £4,545. It means you're losing around £455 due to depreciation. Yes, due to the value of the money dropped. So that's why we need to look around this very closely, and we can calculate 7,000 if we'll get after 2 years. So actually we're not getting 7,000, we are getting £5,782. So if year 3 you're getting 8,000 and times by your discount factor, actually you're getting £6,008. So can we add all these positive numbers, please?
Yes. The last column, the present value is 4545.
Last column present value. So all positive numbers first.
Okay.
And then minus your negative numbers, and we'll see is your positive higher or negative higher.
Okay, so the sum equals to 16,335.
So that's your positive value, and minus your 20,000.
Minus 20,000. So the value is 3,665.
£3,665. That's your negative NPV.
Yes, negative.
NPV means the net. This present value, what is it? Your net. So your net is coming negative. So we reject the project. Actually, they're not covering the cost which you are going to be invest in 3 years. because that's the money you're getting. In the real value is a negative 3,665 pounds. So what's the point? If you look there, actually you're getting 12 plus 8, exactly what you investing you're getting, yes? But in term of the value, what you getting, that's a negative. Even you getting 20, but that 20,000 will be 3,665 pound less value if you're getting 20,000 today.
Yep.
Because actually you're investing 20. Okay, so that's all about the concept. We need to look around, and that's the way we can calculate. We can add some examples in our assignment as well. So next we have, like, we can look around. We are investing 120,000. We're getting all this money. We can times by, this time we are using 8% discount factor, and then we found our positive value is higher than the negative, which is our investment. So we accept the project in this case. Otherwise, we reject the project. Any question? Okay, so next is these are all examples. So you can use payback period. You can decide either you invest in these projects or not. So that's a payback net present value application we can use in the various organization in various perspective when we buy assets. So next method we are looking ARR. ARR is called accounting rate of return. So accounting rate of return is the ratio of the average profit to initial capital employed. It can be expressed as average profit divided by initial capital. Initial capital mean initial investment, and times 100. Whenever we need to calculate the percentage, we always need to multiply with 100. So next we're looking here. So we have an investment appraisal. We're investing money year 1, 2, 3, 4, 5. We're looking Handover, Bristol, Carlisle, and then we add them all. So 5 year you're getting 1 million back. We have 3 different projects: Handover, Bristol, and Carlisle. We can say project A, B, and C. So one project required 4 million, other required 4 million, the third one is required 5 million investment if we will want to invest in these projects. Like we can say, you can produce electricity from coal, you can produce electricity from wind, you can produce electricity from solar. Yes. So we have each project, but if you invest in A, so you will carry on getting 1 million back every year. So in 5 years, you will get 5 million back. Yes. So you're investing 4 and you're getting 5. So it means your profit is 1. So divided by 1 divided by 5, because that 1 million came in 5 years. So divided by 5, it means you're getting average profit every year is 0.2. So 0.2 is your average profit divided by 4 times 100. So this 0.2 is how much percent against your investment? Yes, so it's only 5% you're getting return. If the bank will give you 5%, and the project will give you 5%, so which one you prefer?
The bank?
Yes, so the bank is secure investment and the project is not a secure investment. So we learn higher the risk, higher the reward. So if you're getting just 5% return, so in the bank you can get 5 as well. So it's better to be invest in bank because there is a security involved. You don't need to be worried, and you should be expect more than 10 or 15% return because you're getting money late. You're missing the opportunity cost involved as well, and end of the day you're getting only 5% average return. And we'll check on the second project. Second project again you're getting 5%. Yes, but you will see there are the different timing. Yes, So first year you're getting 1.5 million back, second year you're getting 2.5, and then you're getting 0.55, and then the last year you're not getting nothing. So you add them all, it's your 5 million you're getting back, you're investing 4 million. So 1 million your profit divided by 5, so you're getting 0.2, it means you're getting 5%, exactly the line. So if I'll compare between one A and B, so B is better than A, yes, because even
Yes,
percentage wise is the same, but in term of the profit wise and the opportunity wise, cost is less in this one. And in the third one, so you need to invest 5 million instead of. So if you don't have a 5 million, then you can choose option A or B. If you have 5 million, then you go for option C, or you have ability, you can afford it to wait a bit longer. So first year you're not getting anything. Year 2 you're getting 0.5. Year 3 you're getting 1.5. Year 4 you're getting 2. So you add them all, and then average profit you're getting 2 million. So you add them all, is a 6 million there, 7 million there, and you're investing 5. So you're getting profit 2 million and divided by 5. So you're getting 0.4 million profit a year, and divided by 0.4 divided by your 5 million times 100. So you're getting 8%. So project C is better because project C is giving us 8% return on our investment. Any question?
Okay. No, sir, I understand, sir.
Okay, brilliant. So that's just a matter of concept we're discussing. Then we have a few examples I included, so you can calculate payback period of each project, and you can decide, which one you go through, or ARR of each project as well. So next method we're looking to measure the ratio. What is meant by ratios?
Ratios are come by when we divide two figures, and can be of different types. It gives us return in terms of percentage.
Brilliant. So financial ratios are useful indicator of the firm performance, financial situation. Most ratio can be calculated from the information provided by financial statement. Ratio can make the comparison between different periods, benchmark, and the company's result. We can use different ratios. These are the 4 major categories. We can categorize them into different category of ratios: profitability, liquidity, use of resources, and financial position ratios. So profitability ratios, where we measure the profit, relationship between income and expenses; liquidity, where we're looking the asset liability in the short-term obligation of the company; and the use of resources, where we're looking how efficient we are using resources, our assets, our liabilities used by the company. So if we have an inventory, how long we are keeping inventory, and we are converting into cash, in finished goods, in trade payables and all. So that's all about the use of resources. Then the financial position ratios, which is long-term commitment, where we're looking how much money borrow we, how much we invested; gearing ratio, how much is money is debt financing, how much is the equity financing; interest cover, how much is the interest, the profit we are generating covered towards interest. So all these, So first ratio is the profitability, that shows the relationship between. So gross profit divided by revenue also known as turnover and sales. So that we can calculate as a gross profit percentage, which is quite good to calculate. So in your assignment, you can include the example. You can choose any company's financial statement, and you can use these ratios, these formula to calculate these ratios. And then operating profit percentage, operating profit divided by revenue. Then specific expense you want to see against revenue, like admin expense, distribution expense. So you can calculate profit from operation you can look around total equity plus non-current liabilities times by, so return on capital employed, it means how much capital you employed, what return you're getting. So that's all. Profit from after tax divided by equity. If you want to calculate the return on equity, equity means the share capital investment. So per shares per investment, how much you're getting return, how many percent you're getting return. Earning per share, if you want to calculate what is the earning, how many shares you have, what is after profit after tax, because whenever you need to calculate that anything like equity return or earning per share, you need after tax, because after tax that profit you can distribute between shareholders. So how many number of shares you have, so each share what you're getting. If it's a 10 pound shares, how much worth of and how much you're gaining each share as a percentage, you can calculate as well. Return on asset, how many worth of asset you have and how much you're getting profit out of it. So you're building, have a million trillion pounds, you have a lot of natural resources, what you're generating out of it. So that's really, the problem we have with many developing countries. Liquidity mean near to cash, most liquid asset that can be converted into. So working capital, normally known as the running capital, is mean the capital is in current asset. We know what is meant by
current assets are the short-term assets, which can be converted into cash or something like
well,
that.
that's a short-term assets, short-term commitments. So that can be. So normally the rules, if is you have liability, current liability and current assets. So you need 2 pound worth of current asset, 1 pound worth of current liability. So normally is a good ratio 2 to 1, but it's not hard and fast rule. Depend which industry we are talking. So it's good to be look around the industry benchmark as well. So asset test ratio are the most liquid ratios or most liquid asset, current asset minus inventory. Inventory, sometimes people don't buy the stock. Stock can be outdated, so that's why we take out from the asset, current asset, cash, trade receivable or prepaid, and bank balance we minus our inventory figures, so we can find what are the current most liquid assets, and then we divide by the current liability. Normally, different analysts say its ratios need to be 1 to 1. It means 1 pound worth of most liquid asset and 1 pound worth of liability. So that's a very sound business position. Then we can look around the use of resources, inventory holding period, how long inventory we are holding, inventory divided by the cost of sale. Cost of sales figure we can find from the our profit and loss account. We can times by 365 and we can calculate how much that's inventory, how quickly we are converting. Inventory turnover, how many times in a year inventory being converted into finished goods. Trade receivable, how quickly. So what do you think, which one is supposed to be quicker, less days, and which one is supposed to be higher days compared to trade?
Receivables should be lower days and payables should be higher days.
Well done. So that's all about, because it means we have a safety net there as much we have saved. So there is a gap. So that will help us to save our business, because end of the day, cash is really, really crucial thing for any business, even for our individuals as well. So that's, we can use these ratios and the use of resources. Asset turnover. Next is the financial position ratio. Normally we calculate two major ratios under the financial position. Profit from operation divided by finance cost. Finance cost is mean interest, which we paid on the borrow money when we borrow money. So profit from operation divided by finance cost is give us how many times our finance cost is lower than against profit. So as many times this is covered, so which is the better for us. So it's mean low risk, and banks, especially the lender, always very keen to look around these ratios, because they want to make sure if 10 years 10%, 20%, your profit drop next year, you will be in a position to pay us the money which you will be borrow from us. So that's we need to look around under the, and then we have last not least financial position ratios, where we're looking non-current liabilities mean the long-term liabilities. Those are more than 1 year commitment. We divide by total equity plus non-current liability and times. There are two formulas. Other formula we can use debt non-current liability divided by just equity figure and times by 100. So we can calculate. Normally, author says if you have a 50% ratio, it means your normally debt is cheaper than equity. So if you have a more debt, 60% debt and 40% equity, so that's a good mixture. But it means you own the 40% company, the rest someone else company is owned by, because equity mean is a shareholder on, other is means someone else own the company. Any question?
All right. I think we are fine, sir.
So these are the ratios. We're not doing the quiz. I copied the link so you can play with it if you want to go through the quiz. So let's go back to our document. So one, I not included the sources of finance, which you all know we discussed a bit. So sources of finance, where we can raise the money. We can raise the money by issuing share. We can borrow money from the banks, overdraft, bank loan, a mortgage. All these are borrowing. Leases is kind of borrowing as well. We can issue some securities. That's all source of finance. Hire purchase, we can buy the things on a hire purchase. And the grants, government grants can be a source of finance. So these are different sources of finance. It can be, these are the long-term finance including, so these are the long-term. Overdraft is the short-term. We can sell our own assets. We can raise our finances. Those are the spare assets, spare capacity we can use. So, or we can give a lend out to raise the finances. So it means how we can, if we need a fund, how we can raise the funds, all about. So always look around the cost and benefit. If you borrow, what will be the cost of your finance if you borrow the money from different sources. So we always look around if we don't need a long-term commitment. So better to be borrow money through our draft for the short period of time if we are short. So any question? So that's all about. We finish our units. Now we need to be focused on assignments. So today we all discuss about the sources of finance, how we can, where we can borrow the money. We discuss about the ratio analysis, and we discuss about investment appraisal and different method of investment appraisal.
Yes.
Have you started your assignment?
Not yet, sir, but I'll be working in the coming week.
Okay, brilliant. So that's absolutely fine. Okay, guys, we'll keep up to lesson here. If you have any question, drop me emails. And today we finish out this unit, and from next week we'll start our new unit. If you have any question, just drop me email. And have a nice time, wonderful time, and I hope so I will speak you soon all.